Hello everyone, my name is Barata and I'm a research associate at the Florence School of Banking and Finance, and today we're going to talk about the too big to fail regulatory dilemma. During the European financial crisis, so between 2008 and 2014, several banks found themselves in an unsound financial situation and at the risk of being liquidated. Their potential liquidation was not a desired option for three reasons. First, given the importance of banks in the provision of liquidity. Secondly, for their potential systemic impact. And thirdly, concerning the information asymmetries that exist. So banks sought for an alternative to liquidation, and the solution that was found was to pursue a bailout strategy. What does bailout mean? In non-technical terms, to bail out a financial institution means to provide it with some insolvency or liquidity support through the central bank, government, or a government authority. With this support, the bank can repay its creditors and restore its financial situation. The party that is bailed out is not the bank itself, but rather the shareholders and the creditors of the bank, who are therefore protected from the losses that they would otherwise suffer with the bank in liquidation. The most extreme example of a bank bailout is a nationalization procedure, which consists in a transfer of ownership of the bank to the state, ideally without the interruption of its business continuity. For the implementation of this bailout strategy during the European financial crisis, public funds were used to rescue the multiple banks that were at risk of insolvency. The reluctance to liquidate is related to the phobia of winding up these institutions so as to protect the financial stability of the whole financial system. And so by decreeing that some of the banks were too big to fail, during the European financial crises, governments authorized for the use of taxpayers' monies to use those whose insolvency could harm financial stability and potentially disrupt the entire financial system. The large-scale use of public money to save systemically significant non-viable banks is therefore closely linked to the idea of accepting a too-big-to-fail status. And this belief contends that regardless of how unsound their financial situation is, systemically important, large-sized and more interconnected banks may not be allowed to fail. Put it simply, these banks somehow hold the states and the taxpayers as hostages to secure their survival. And it's impressive that 13 years after the fall of Lehman Brothers, the too big to fail thesis continues to frame much of the public policy debate on financial stability and on banking regulation. During the European financial crisis, the too big to fail status of banks was considered one of the great unresolved problems of banking supervision, and also one of the most significant challenges ever confronted by regulators and competition authorities. These two perspectives show that this too big to fail status was perceived as a huge risk. So, to avoid the failure of a systemically important bank, governments were expected to bail out the creditors of the financial institution instead of risking the safety of the whole financial system. By taking somehow this preventive approach, the chances of a bank shutting down were seriously limited. And the phobia of closing systemically important banks prevented these banks from exiting the market, which exacerbated the overbanking phenomenon that characterizes the European banking sector. So avoiding the liquidation of these banks by supporting a too big to fail approach had multiple ramifications. First, competition, distortions and market concentrations. Secondly, high levels of public expenditure. And thirdly, moral hazard. Let's unpack each of these three consequences. First, the too big to fail approach caused competition distortions and increased market concentration in the banking sector. It distorted competition because inefficient financial institutions were artificially kept operating in the market after being rescued, side by side with banks that had not been rescued. And so by pursuing such a rescue policy, the EU sent a strong message to the financial industry, which was that the enforcement of banking competition rules could be sacrificed for the protection of financial stability. Furthermore, if only some players were considered too big to fail, it was implicit that for some banks were safer than the others. So in particular, small and medium-sized banks did not benefit from rescue guarantees, and here, in this particular case, faced a disadvantage. So overall, an excessive reliance on the too big to fail approach prevented unsound financial firms from closing down, promoted rescue mergers and takeovers that contributed to increase the market concentration in the EU banking sector. The link between the bailout strategy and the levels of market concentration raises questions about the EU policy decisions before and during the financial crisis. And this link is reflected on the market concentration statistics that were published by the ECB in 2017 in its report with the title "Report on Financial Structures Shows Ongoing Consolidation in the Banking Sector." The second consequence of the too big to fail idea is linked to the excessive levels of public expenditure. So the use of taxpayers' money to protect the collapse of the financial system was extremely controversial, and even if it was authorized by the European Commission in compliance with the state aid framework. Just to have an idea, between 2007 and 2014, DG Comp managed the restructuring or order resolution of 111 EU banking institutions and approved 450 state aid decisions in the banking sector. In the same period, state aid measures exceeded 5 trillion euros in the financial sector and therefore costed, according to the Finance Watch, each EU citizen 3,800 euros. Lastly, the too big to fail dilemma was also a source of controversy due to the risk of enhancing a moral hazard effect among too big to fail banks. The effect stemmed from the expectation that governments would bail out the creditors of a systemically important financial institution, which could therefore rely on an implicit guarantee or subsidy. And the guarantee was implicit because there was no explicit ex ante commitment by the state to bail out the bank in the event of financial troubles. However, the too big to fail banks implicitly expected this guarantee to exist, creating a moral hazard effect among them. So, the efforts to eliminate the too big to fail approach have converged in the belief that failure should be a possibility for every bank. And having the option to fail is a decisive step to discourage a too big to fail strategy and consequently the three multiple problematic ramifications that we just unpacked here. Allowing banks to fail is also an important element of market discipline. That is a mechanism via which market participants monitor and discipline the excessive risk-taking behavior of banks. From a competition perspective, if all banks are potentially allowed to be shut down, it is more likely that inefficient players exit the sector and are replaced by new entrants. And necessarily linked with the possibility of financial institutions exiting the market is the impact of such a regulatory measure on the levels of market concentration within the sector. So secondly, if all banks are potentially allowed to close down, the use of state aid funds also most likely decreases. So EU taxpayers have voiced their unwillingness to accept being burdened with risky business strategies and with government's emergency decisions, regardless of the systemic impact potentially caused by some bank liquidations. So finally, by removing the implicit guarantee that some financial institutions always have a backup rescuer, the moral hazard problem is also expected to come to an end.